this graph, right? And what I asked you to do is to go home and try to explain the relationship between spot and forward using this graph. Can you view my screen?
Yes.
Yes, teacher.
All right. So anyone can tell us what's going on with this graph?
Yes, teacher.
I,
This shows us that there are two ways that a foreign currency can be converted into the US dollars at time T. And the the first the first way is on the left branch is that we can use 1,000 unit of foreign currency and then deposit at the rate RF, and we can deposit it in the time T, and in addition we enter a forward contract, and we can convert it into the US dollars at time T, which is 1,000 times F0 and times E to the power of RF multiplied by T. And the second way, we can convert the foreign currency into the US dollars at time T. First, we can convert 1,000 units of foreign currency into the US dollars at time 0 by taking 1,000 unit of foreign currency and multiply by S0, and we can have the US dollars at time 0.
0 can be understood as the
S0 is a spot rate, the spot exchange rate.
Yeah, the spot exchange rate before the foreign currency, between the current for the foreign currency and the US dollars, right?
Yes. After converting foreign currency into US dollars at time 0, we can deposit it with the interest rate in US for the US dollars, and at time T we can achieve 1,000 multiplied by S0 and multiplied by E to the power of RT.
Okay. Do you agree with Lam? He's explained the two ways of using the 1,000 unit of foreign currency at time T equal to 0, which is the moment, the current moment, and then at time T, right? There are two possible ways to deal with 1,000 units of foreign currency at time 0, to have 1,000 multiply with the exchange rate when we want to change it into the US dollars. So the first thing to do is the left-hand side of this graph. The left-hand side of this graph, as Long explained, that what we can do is we use the 1,000 unit of foreign currency at time 0 to invest at the certain risk-free rate. So basically, we would achieve 1,000 unit of foreign currency multiply with the risk-free rate if we invest at RF, right? And in order to gain 1,000 units of foreign currency at time T plus the risk-free rate RF, and then we enter the forward contract to sell the 1,000 unit of foreign currency to exchange for US dollars. So at time T, then we would have 1,000 multiplied with the F0 raised multiplied by E to the power of RFT. Right? And the second way of using 1,000 unit of foreign currency is to exchange it at time 0 right away. So we have 1,000 multiplied with the spot price, S0 of dollars. So basically we convert the 1,000 units of foreign currency into US dollars. And then we invest it at the rate R in order to get 1,000 multiplied with the S0 and E to the power of RT at time T. So this is to explain the relationship between spot price and forward price, and in the absence of arbitrage opportunity, these two results must be equal results, must be equal if there is no arbitrage opportunity. If there exists arbitrage opportunity, then the strategies that you cost per unit time as the percentage of the asset value. So it is expressed as percent unit of measurement. Then we would have this formula hold F0 will be less or equal to S0 multiplied by E to the power of R plus U, all of them multiplied by T, right? And if U is expressed as the absolute value, which means that we pay by money upfront rather than expressed in percentage, then the formula would change a little bit. We would have F0 is less or equal to S0 plus U. So U is a storage cost. And remember, if the storage cost is input in the formula, then this must be the present value of the storage cost. If the storage cost is expected to be paid at the end of the period or in the middle of the holding period, then you must discount the storage cost back to the present value and then input it in the formula as here, right? And as S0 plus bigger U, all of them multiplied by E to the power of RT. Okay. And these two formulas are applied for what is called consumption assets. Okay, consumption assets. Remember, we have already identified the differences between consumption assets and investment assets at the beginning of this session. And basically, the difference between consumption assets and investment assets lie in the way, in the objective of holding the assets. So those investors who engaged in trading consumption assets or holding consumption assets, the ultimate goal is to hold it for consumption. And for investment assets, the goal is to invest only, right? Let's pay attention to this part a little bit. Normally, right, when you see the formulas between the two parts of the formula. So normally you can see F0 is equal to S0 multiplied by E to the power of R plus U, all of them multiplied by T. But in this formula, or in the formula if U is expressed as the absolute value rather than percentage, then we can see one difference lie in the way that we have the smaller sign, smaller or equal to. Right. What does this mean? We understand that if f0 is equal to s0 multiplied by e to the power of rt, right, normally, right, then what we have here is there is no arbitrage opportunity if the relationship holds. Right? If there is an equal sign, then there is in this case, as you can see, we have a smaller sign, right? Smaller sign added together with the equal sign, which means that if f0 is less or equal to s0 multiplied by e to the power of r plus u, all of them multiplied by t, then there is no arbitrage opportunity. Yeah. My question here is, why do we have a different sign in this situation? What do you think is the reason for this? Why do we have this difference? What do you think? What do you think?
I think that here we have the smaller sign because, from my point of view, because for the consumption assets, the investor is like not, they don't want to sell this assets to buy a forward or future contract, because I think they want to consume for today, and the forward and future contract cannot be consumed. So I think the price for the forward and future will smaller than the spot price if we multiply.
What does it mean by we cannot consume? Why don't we? Why do you think so? Why can't we consume?
It's like if you have a consumption asset, so I think for the investor they want to consume now, and but if we convert this asset into forward or future contract, so you can't consume it.
Why not?
Oh, it's
if we end up exercising the contract, then there would be exchange of the assets, and we certainly can consume it.
But I think the investor want to consume for today than in the future. It's my opinion.
For today than the future?
Yeah.
Not really. What if they want to consume in the future?
I will think deeper.
Okay, thank you, Đức Anh. Any other idea? I am trying to start the whiteboard, but it's taking a long time. Yeah, it cannot display the content. Okay. Okay, just insert a slide. All right. So let me just represent the situation again so that we can have a better understanding. Oops. So we are talking about the situation. Normally, right, we would have the case F0 would be equal to S0 multiplied by e to the power of RT. Okay, if this holds, then there is no arbitrage opportunity. Basically, no arbitrage. You agree with me?
Is it just me, or aren't you showing anything on your screen right now?
Really? All right. Okay.
Sorry.
It's okay. Thank you for reminding me. I didn't know that it was not being shown on the screen. Can you see it now?
Yes, thanks.
All right. So this is what we are talking about. No arbitrage opportunity if F0 is supposed to be the same as S0 multiplied by e to the power of RT. Do you agree with me? Then if this equal sign does not hold, then we would have arbitrage opportunity. So let's take a look at the first case where F0 is more than S0 multiplied by e to the power of RT. And we would have the second case where we have F0 is less than S0 multiplied by e to the power of RT. Oops. So if F0 is more than, right, more than S0 multiplied by e to the power of RT, then what should be our strategy?
We will buy the asset and short the forward future contract.
We buy the asset, short the future?
Yes, just short the future.
Or short forward? You agree with who is speaking?
My name is Tang.
Okay, Tang. Do you agree with Tang? He's suggesting us that we should buy the asset and short. Okay, so I just input it here. Oops. We buy the asset and we short. Right. Do you agree with us? Or you do agree with Tang? In order to buy the asset, okay, then we borrow, right? We borrow S0, to buy the assets, right? And we short forward. Because basically over here, if F0 is more than, then it is favorable. Then we buy low and sell high, so we sell F, right? And opposite this case, if F is smaller than F0 is smaller than S0 multiplied by e to the power of RT, then what do we do?
I think that we will long the forward contract and short selling the commodity.
F, and
Yes,
then
short selling.
do not know what asset do we have. Like we just say we sell the asset. So it's only applied to stock.
And then we will invest.
So because we sell the assets or short sell the stock, then we would have the money in hand and we would invest the money that we have from selling the asset. Okay. So in the two cases, we will make profit. The profit that we make in the first situation, in this situation, will be what? Profit would be?
Profit would be F0 minus S0 multiply E power to R multiply with T. Cô dạo này bị lag rồi.
B. There's no arbitrage opportunity then. S0 multiplied by e to the power of RT. But if the equal sign does not hold, then for each situation, we would have the strategies corresponding to the situation based on the principle of buy low and sell high, right? Then if F0 is more than S0 multiplied by e to the power of RT, then we borrow the price at the spot price S0, and then we buy the asset, and then we short forward. Right? The profit that we can realize would be the difference between F0 and S0. The asset, and we invest the money that we got from selling the asset at the certain interest rate. So the profit we can realize would be the difference between S0 multiplied by e to the power of RT minus F0.
I'm sorry, but is it just me that has like some connection problems, because you're sometimes like gone for some seconds, and so some of the phrases you say are missing?
Yeah, me too.
Really? Oh, okay. Probably.
I have
Sorry.
same problem.
Okay. Anyway, can you hear me clearly now?
Yes.
Okay. Sorry, because I don't know how to deal with the connection. Is out of my hand. Anyway, So you all agree with us that we have two cases like this, right?
Yes.
Okay. So now let's get back to our situation where we have the consumption asset. So basically, F0 would be less than or equal to S0 multiplied by E to the power of R plus U, all of them multiplied by T. Then we do not have arbitrage opportunity, which means that for this situation, right? Let's say for this situation, then we would have this one. Just a moment, I just erase it. We would no longer realize the profit from this situation. We understand that if the equal sign holds, then obviously no arbitrage. But if the smaller sign also holds, then we cannot realize the profit from exercising this strategy. Only this strategy is applied. Tell me why. Obviously, we have to include the storage cost because this is a consumption asset. But anyway, let's just simplify it a little bit and take a look at the two possible strategy in comparison with the other kind of assets. So in this situation, right, for consumption asset, when F0 is less than S0, multiply or plus U, all of them multiply by E to the power of RT, then we cannot exercise this strategy and cannot realize the profit. Why can't we? Why can't we, like long, forward or future, then sell the asset and then invest the money and realize the profit?
I think because this is a form of short selling, and for some assets, it is forbidden. So that's why we can't perform that strategy.
Because you think short selling is not available for different assets besides the stock?
I think so.
Yeah, but we are okay. We talk about if short selling is not available, and obviously, as you can see, we cannot short sell the consumption asset because it's not available. Basically, the trading is not available for that. But those who have the assets can still exercise the strategy, right? Last time we also talked about what if short selling is not available in some markets. Then we also said that if short sell is not available, then the traders who own the asset, right, who possess the assets, will still be able to do the same thing, to lock in profit. So my question here is why? Why cannot we carry out this strategy?
Doesn't the first step that we buy the long the forward contract imply that we at some point buy the asset again? And I guess with consumption commodities, this isn't like applicable to make profit in the end, because
Well-
they must be used to produce something, for example, like oil or corn or something like that.
What do you mean by to produce something? You mean that you need the asset to do something, so
and like the forward or something like that isn't like consumable, but the underlying asset, right?
what if when we enter the forward or future contract, you may have to think about the time that you need to use the asset, right? And you calculate the appropriate time so that you still be able to enter the contract and then finish it and still have the asset to use afterwards.
Okay, well, then I don't know the answer.
But it's a good guess, yeah. But just suppose that, okay, the timing is perfect, right? You can plan the time just in time for you to, after finishing the contract, exercising the contract, we are still in time to use the asset. Then what?
I think maybe we cannot exercise a long forward contracts because people don't often store the consumption assets. So there is no available supply for us to buy the consumption asset at the future. I guess so.
It's not the reason. Suppose that you are entering a very big market, right? Like in the US or in the UK, then I don't think the assets are not available. And suppose you have to think that we may enter the market that probably it is worldwide. So not only within we have domestic trading, but also international trading. So. Any more reasons that you can think of?
I think that for the consumption assets, so the purpose is to consume. So I think they can sell the assets right now because they need to consume and buy the forward.
Yeah, if they need to
Right?
consume, they can sell the asset at the moment and then exercise the forward contract or future contract in the future and still own the asset to consume. Obviously, Đức Anh is correct in saying that consumption assets are held by the investors for the purpose of consumption. So after all, the trader will have to use the asset because when they enter the consumption, when they buy the consumption asset or they possess the consumption asset, they will need to use it at some certain point of time. But persuade me with more reasonable reason. Think about the consumption assets. Think about the features that make it very, distinguished. And because of that, you cannot exercise this strategy to lock in profit. Given? Any other ideas? No more ideas? No more ideas? You surrender? You know, the features of the consumption assets that make it so distinguished is the okay, is the quality of the asset, right? Because the assets may have different types of assets based on its quality. For example, if you consume the rice, for example, we may have different kinds of rice. We have fragrance rice, we have long grain, we have short grain, so many types of rice, right? When the trader consume the assets for the consumption assets, their ultimate goal is for consumption. They have to use it in a future period of time. Even oil, right? You have crude oil, you have type this and type that kind of oil. And due to the quality of the asset, then if the trader enter the long forward or future contract to buy the asset and they decide to sell the asset now, there hardly be the chance when they can, you know, even if they exercise the forward contract, they can buy the exact same type of asset that they want. For example, they have sold the asset, the rice, fragrant rice, right? But when they long the forward contract, there is no guarantee that the type of rice that the investor wants would be exactly the same type. That is why for consumption asset, this strategy is not available because basically they cannot get the same type of asset, consumption assets, when they already sold it and then enter the long forward, the forward or the future contract. Okay. So remember for the consumption asset that we would have the smaller sign holds as well together with the equal sign. Okay, and remember, if U is expressed as the absolute value of the storage cost, then you always have to bring this storage cost back to the present value. Okay. Okay, there is a definition that we also have to bear in mind in valuing the forward or future. It is called cost of carry, and the cost of carry is denoted as a small c. The small c, the cost of carry, is defined as the storage cost plus the interest cost less the income earned for a certain asset. So for investment asset, we would have this formula hold. F0 would be equal to S0 multiplied by e to the power of CT. Right? When we take into consideration the storage cost, and C would be equal to the storage cost plus the cost, sorry, C, the cost of carry would be equal to the storage cost plus the interest cost less any income earned during the holding period. And for consumption asset, then we would have similar formula, but remember, due to the feature of the consumption asset, then we would have the smaller sign hold. And when we have these formulas hold, then we understand that there is no arbitrage opportunity. Okay. All right. We also have the definition of what is called the convenience yield on the consumption asset. Convenience yield would be defined as the yield at which, if you compare between, having the asset itself and not having the asset itself. So when it incurs, it has the what is called the convenience yield, then you have to input it, you have to take it into account and put it into the formula so that you will be able to value the price of the forward in a precise way. So F0 would be equal to S0 multiplied by E to the power of the cost of carry minus the convenience yield, all of them multiplied by T. And this is how we value the F0. And we understand that if the equal sign occurs, right, then we will have no arbitrage opportunity. So to wrap up, we would have the value of the forward contract and the forward price. The forward price would be valued in each situation where we have no income. When we have income I as the notation, it would be the present value of all the income that will be received during the holding period or during the maturity of the contract. So basically, with the income, then we would have F would be equal to S minus I. I is expressed as the present value of the income multiplied by e to the power of RT. And we would have the small f, which stands for the value of the forward contract, would be the difference between S minus I minus K multiplied by e to the power of minus RT. And if we take into consideration a certain yield generated by the asset, then we would have this formula to value the forward price would be equal to S multiplied by E raised to the power of R minus Q multiplied by T. And if it is, the commodity, then we would have to consider the storage cost plus the, the rate, interest rate, and minus the yield, right? Okay, so basically this is the wrap-up table for you to see how we value the forward contract and the forward price. Okay, so we also talk about something about the future prices and the expected future spot price. If we compare, if we suppose that we have K is called the expected return required by an investor to create the cash inflow of ST at maturity. Then basically this shows that we would have the the relationship holds between F0 multiplied by e to the power of minus RT multiplied by e to the power of KT would be equal to the expected value of ST. Right? Or if we rearrange the formula a little bit, then F0 would be equal to the expected value of ST discounted back at the present value, and we take the difference between the risk-free rate and the expected return required by the investor on the asset.
Cô giải thích lại cái slide này được không ạ? Vừa nãy nó hơi bị giật hiện.
Again, okay.
Cảm ơn.
This is just to explain, like, you know, sometimes if we want to compare between, if the investors has the required rate of return and we want to take into consideration the both the risk-free rate or the expected rate and return, then we by equaling the two sides of the formula between F0 multiplied by e to the power of minus RT and KT, then we rearrange the formula. We would say the F0 can be valued by the expected value of ST, right, multiplied by e to the power of R minus K multiplied by T. This is similar to what we have discussed in the previous formula. When we have the income generated by an asset, we also take R minus Q, remember, then we multiply with T. Okay, so in the case that we do not have any systematic risk, right, no systematic risk, then we could understand that K would be equal to R, okay? And then we would have F0 equal to the expected price of ST. But when we have the positive systematic risk, then K would be bigger than R, right? The required rate of return would be more than the risk-free rate of return. Then we would have F0 is less than the expected value of ST. And when we have negative systematic risk, then K would be smaller than R, then we would have this relationship hold, okay? We would have some trends in the prices of the future contract. And there are two kind of trends, prices changes trend, and we call it the contango and the backwardation. So contango is defined as the situation or the price trend in which the future price is above the expected future spot price. Okay, so as you can see, we have the red line represent the contango trend. Basically, contango means future price is above the expected future spot price. So basically, we compare between the two prices. And the backwardation would be the trend in which we can see the future price is below the expected future spot price. Okay. In normal backwardation, the future prices would be increasing over time, and at some certain point of time, we would expect that there would be the conversion of prices. So the expected future spot price will converge together with the future price. Okay, and that is the end of the chapter. So I think now we'll spend some time doing these exercises as the practice exercises for you to better understand the whole chapter. So I'll give you about half an hour to do these exercises. Do you think it's enough for you? Have you been able to copy the exercises, or do we have the exercises in the slides already? Do we have it in the slides already, or?
No, we don't have it. Can you show it again?
Okay, I will message you in the team.
Teacher, I have texted the number of the exercise, so you don't have to text it again.
Okay, thank you very much, Ami. Have you finished? Let's off some of the first questions that are very simple. We can do it together. Question 5.3. What's your final answer? You can type on the message so that we can see, we can share together. .3 is very simple, right? Okay. Yes. Diệu Hằng and Lê Kiều showing the full answer, right? Forward price. And most of you get the correct answer. 31.86. Okay, thank you very much. Remember, we have to adjust the time accordingly with the maturity of the contract, right? So here we only have 6 month forward contract. So T is 6/12. Okay, problem solving 5.4. This is to calculate the index, the forward price of the index. Similar formula is applied, but over here, as we have the yield of 4%, right? And we apply the formula to calculate. So we have the risk-free rate minus the Q. Very good, Gil. So a lot of you have it done. And the final answer is 354.7. Yes, very good. So most of you get this correct. 5.9. 5.9, I think we need someone to explain, to do it and explain to the whole class. Who volunteered to do it? Okay, Đức Thắng then.
Okay, may I share my screen?
Yes, please.
I'm sorry, I cannot share my screen right now because some problems.
Again, the problem again. I remember last time Tang is trying to do the same thing. Well, actually, you can try to explain it in the chat so that everyone can look at it.
Okay. So firstly, we'll calculate the forward price by the formula F0 is equal to S0 times e to the power of RT, and this is equal to 40 times e to the power of 10% times 1 year, and is equal to 44.21. And this is at the time is time 0, so the initial value of the contract is 0.
It's 0. Why?
Because the forward price is equal to the delivery price. So
if it's not equal to 0, then the arbitrage opportunity exists, right? Supposedly, although we may have some kind of differences between the bid and ask price, but normally when we enter the forward contract, the initial value of the contract is equal to 0. Yes.
Yeah.
Okay.
Okay. For question B, so we calculate.
Oh, you have Tang. You have to write down the number as the final result. So F0 would be equal to
F0 is equal to 44.21, and the value of the contract, the small f, is equal to 0. For question B, F0 is equal to 45 times e to the power of 0.1 and times t is equal to 0.5, and here is the value of the forward price. Okay.
The value of the forward price,
and we have the delivery price is the one we have calculated in the part A is equal to 44 times 21, and for the value of the contract we have the formula F equals to F0 minus A times e to the power of minus RT, which is equal, let me type it.
So 45 is the price of what?
40 price is the current price.
The spot price, current spot price.
Yes.
All right. So for the current spot price, if it is 45, then 6 months later, when you want to value the forward price of the contract, you have to use the spot price, the updated spot price up to the point of time of 6 months, right?
Yes.
That is why Tang is trying to input into the same formula F0 is equal to 45, which is the spot price 6 months later, multiplied by E. Remember small e, to the power of the rate multiplied by the T, which is 6 months later. So basically, we apply the same formula to calculate the forward price 6 months later. Since we have the variable of spot price change, there the forward price valued at 6 months later will change as well. The forward price that we calculated in question A would be the delivery price, right?
Of
the delivery price of the contract.
Which is K.
Yeah, okay, which is K.
So
Chami, I can see your answer up here when you say the delivery price K is 45 is actually not correct, because that is the spot price 6 months later. Okay. When we want to, for example, if you enter the contract 6 months later, then what you are valuing the forward price F0, then it would be the spot price S0. Sorry, the value of the forward contract. Then we take the spot price minus the exercise price discounted back at the present time, which is 6 months, right, rather than the whole year. So when you say delivery price K is equal to 45, that is not precise. Okay, then Thang, take the difference between the what's over here?
The forward price and the delivery price.
Mm-hmm.
And we times E to the power of minus 1.0.
Why do you have to discount?
Just discount into the present.
Discount back to the present. You can always take the 45 minus the delivery price, the 44.20 21 that you calculated in question A, and then you discount it back to the present, right?
Yes.
Because what we are trying to value is the value of the contract given the situation that we have the current new spot price and the exercise price. So it should be, Thang, you want to correct it?
I deliver the same results when we do by the another way, but here I want to take the difference and I discount back into the present to know the value of the contract.
Yes, but the more precise way to do is to take into, you don't have to discount it back and forth like that. Just take the 45 minus the rest of it, then this is the best way to do it. 45 minus 44.20 discount back after 6 months, right? Back at the period of time 6 months, like previous 6 months, or what do we say? Because the contract is about to mature in a year, right? And we are in the middle of the year. We are in the first 6 months. So basically, this, although it will give you the same result, but this must be done. The more correct way is you take the difference between the spot price minus the exercise price discounted back at the present time. which is equal to the same as 2.95. But this is the more precise way to do it. Okay. Let me see. Point 11. This is also easy as well, right? So you just show me your results, everyone. The most difficult thing in this question is we have different dividends payment in different time. In different month of the year, right? So how do you do it? Let me see. Okay, Chami said that we take the average. So we use the rate, we multiply with the month, and we take the average. That's right. Then we apply the normal formula. Okay, great. So 1,331.80 is the final result. Mayang has got a little bit different result. And most of you got the same result. 1,331.80. And Đức Anh, you are having the wrong result as you are making a mistake by dot and comma. Remember, we have dot in English will be this comma in Vietnamese, right? And you are, since you are doing this course in English, so you have to reverse it. Okay, like Chang Nhung, Chen Chang Nhung, the way she wrote it is correct. Okay, then we have 5.12. You know, Đức Anh, one time, one student failed in the final graduation exam, the English final graduation exam, because of the mistake of comma and dot. Because the Board of Examiner just said that we should not release the student like this to the market, to the labor market, because he or she is going to make a great loss to the corporation if he if he drops the contract. You know, instead of $1 billion, then it would be the contract that is worth only $1. So be careful, okay? Okay, 5.12. 5.12, everyone. Okay, 5.12. The thing here is we have to calculate the expected, the theoretical price, right? the future price, and it is equal to 408.08, yes. And the price being quoted in the market is 405. So we can see the price differences. The thing here is we would have to work out the strategy in order to lock in arbitrage profit. So your strategy will be whatever is lower we buy in, whatever is higher we sell out. So the future price is low, so we buy the future contract and we short sell the share, right? Short sell the shares of the underlying index. Okay, very good. 5.14. Ming Cha has the question if the investor already owns the asset and then sell it. If the investor does not hold the asset, then he does not have to pay for the storage cost. Unless the strategy is to hold the asset for a certain period of time, then we would have to consider the storage cost. Is that what you mean or what? What do you mean? When we want to calculate the forward price, then you have to take into account the storage cost. But when you work out the strategy and the investor does not hold the asset for a certain period of time, then we do not have to pay for the storage cost. But originally, when you calculate the forward price, when we have the storage cost, then you have to input the storage cost into the calculation to reflect the theoretical price of forward or future. Does it help? Okay. 14 and 15. 14 and 15. Probably someone can, okay. Oh, we are running out of time. Okay, Thảo. Kim Thảo. Well, are you Vietnamese?
No, I'm German.
Yeah, but your name looks like Vietnamese. That's.
Yeah, I was born in Vietnam.
Oh, really? Interesting. So the combination between all your parents, one of them is Vietnamese, or?
Both of them are Vietnamese, but I was adopted as a child.
Oh, nice. Okay. And you're living in Germany?
Yeah, but I'm planning to go to Vietnam soon.
Can you speak Vietnamese?
No, unfortunately not.
You should learn.
Sorry.
You should learn Vietnamese if you want to stay here, and probably get married to a Vietnamese gentleman.
Good strategy, I guess.
Okay, 5.14. So we have the future price that Thảo is calculating is correct, right? You share the same result with her? And we compare it with the current price. And she concludes that there is an arbitrage opportunity. So basically, her strategy is to buy Swiss francs and short Swiss francs future contract on Swiss francs. Okay, very good, Thao. All right, the last one, problem 5.50. Okay, so basically, before we incorporating the storage cost into the formula, as we can see, the storage costs are divided into different payments, right? Due to different period of time. So basically, we have to discount this cost back at the present time, and then we just replace it into the formula to calculate the forward price. Okay, so the storage cost after discounting would be 0.1756, and then the future price would be 9.89. Okay, very good. Very good, everyone. So I think it's very easy for all of you, right? This module you can pass at ease. Okay, and any question for today?